Hello everyone, welcome back to my channel. Today we are talking about risk management and I want to start by killing a myth. Most people think risk management means controlling risk. It actually doesn't. You can't control risk any more than you can control the weather. What you can control is how you respond to it. That's the whole episode right there. Here's an example. Say there's a chance of rain on your way to the office. Do you cancel your plans? No. You adapt. You leave a little earlier or you carry an umbrella. The rain didn't change. Your behavior did. Now say it's a cyclone warning instead. You don't adapt to a cyclone. You take the day off. Same category, weather risk, but two completely different responses because the consequences is completely different. That's risk management in one image. You are not modifying the risk, you are modifying yourself. Before we deep dive into the risk management, here's a quick disclaimer. I am not a SEBI registered advisor. This video is strictly for educational purposes. Consult your financial advisor before investing into the markets as it contains risk. For more details about risks associated with the markets, check out the video I made about understanding market risk. So, every risk actually has two parts. First, probability. How likely is it? And consequences. How much would it hurt if it happened? Rain is a high probability but low consequence. A cyclone is a lower probability but massive consequence. Good risk management asks about both, not just how likely is this going to happen. Now, here's the reframe that changes everything. Risk, in simple terms, just means the possibility of an unexpected outcome. And unexpected outcomes aren't always bad. A negative surprise, that's a risk. A positive surprise, that's an opportunity. Same uncertainty, two different faces, which is exactly why we invest in risky assets in the first place for the chance of a positive surprise, even though we can never rule out a negative one. So, we should always talk about risk and opportunity in the same breath, not as two separate conversations. A right mindset is key to an effective risk management plan because a risk event like a market crash will definitely make you panic. For the right mindset, you need to accept two things. First thing, we don't know how much return an equity or risky investment will generate. Second one, we don't know when that return will show up in our portfolio. That's it. Once you genuinely accept both, not just nod, but actually accept it, you can finally deal with risk instead of panicking every single time the market moves, whether in your direction or against you. So, what does risk actually look like in your portfolio? There are major six things. First, a major temporary decrease in value. Not being able to sell when you need to, for example, because of a circuit freeze on the stock that you are owning. A delayed return. It comes just later than planned. Total loss of capital. The worst case where the stock gets delisted or there's a major fraud in a company which unfortunately you happen to own. Returns that come in lower than inflation, so you are losing purchasing power even while gaining on paper. And finally, big profits in a short time. This sounds like the best outcome, but if you are not prepared to take these profits and redeploy them, you can waste the entire opportunity. Keep in mind, taking profits is one of the most difficult skills, even for a seasoned investor. Naming these is the whole point. Once you know what can happen, you can actually prepare for it. Once you know the possible outcomes, there are really only two moments where you get to act. First is before the surprise happens, and second is after it happens. So let's go through both. Before we go further, if you have made it this far, please take a moment to like this video if it's add value, subscribe to the channel for regular updates, and leave a comment if you enjoyed it. Before the surprise, this is the preparation phase. While you are calm and thinking clearly, don't invest more than 5% of your portfolio in any single stock. This limits your loss if something goes seriously wrong at the company you own. Diversify across equity, debt, gold, and real estate. It smooths out volatility in your portfolio since one asset class or another will usually be outperforming the rest. Hedge by buying put options against a long position. Using options to hedge is an advanced concept that an individual investor may not be able to execute correctly, so it's better to avoid it early in your investing journey. Buy medical insurance so a health emergency never forces you to sell investments at the wrong time. Hold income generating assets such as rental property or high dividend paying stocks. So you are not dependent on selling your positions to raise cash. And keep a sufficient emergency fund to cover your uninsured emergencies. After the surprise, your toolkit is actually smaller, and that's the point. Mainly two moves only. First, book a small loss at a stop loss so a wrong decision doesn't snowball into a much bigger one. Psychologically, this is very difficult and takes practice to overcome. Rebalance your portfolio when one asset class has moved sharply up or sharply down, bringing your allocation back to where it should be. Psychologically, this is easy and it's the bare minimum every investor should do. So, as you can appreciate, real risk management is mostly the work you do before the surprise happens. Based on how this lands, I am planning a full episode of each one of these: position sizing, diversification, rebalancing, insurance as protection, income assets, stop loss discipline, emergency funds, investor psychology, and rule based selling. One deep dive at a time. Comment below with the topic you want me to cover next. Subscribe so you don't miss the next one in this series. Until then, thank you for watching and see you in the next video.